Welcome to the Jay Tyner Show, where we discuss all things wealth management and retirement planning. And as always, the goal of our team here at Semmax Financial Group is to help you focus more on your life and less on your money. Now, as a reminder, check with your current advisor, planner, CPA, and read our disclosure in the video description below. Subscribe to this channel if you want to stay up to date on all of our new content. And by the way, if you have questions or need a 15-minute free consultation, please visit semmax.com or call 336-856-0080.
Hey there, everybody. Welcome to the Jay Tyner Show. I'm Jeffrey Griffin, along with Jay Tyner and Matt Landon. And the topic for this episode, how retirees can cope with inflation. And it almost makes me nervous right off the bat. So it's been a wonderful run in regards to inflation, right? It's been low. We've had years of it. Right. Now, we hope coming out of the pandemic, prices, demand, everything's starting to go up. So, I mean, Jay, 25 years ago, you all invest in a Honda Accord.
Yeah.
And then what's the difference if you get it 25 years ago or now?
Well, literally, it was right at $15,000 for a brand new Honda Accord 25 years ago. And a year or two ago, we went across the street, over the flow, looking at the Hondas, right? I know I do a little advertising there for them. But anyway, looking at the Honda Accord, and they're $30,000. That's a 100% increase. So think about this. If you're retiring now and need $100,000 of income, 25 years from now, you're going to need 100% more. You're going to need $200,000 of income just to buy the same eggs, the same milk. You know what it's
so
a little
what is
scary.
the first step? I mean, it's intimidating off the bat. So what's the best first step? Where do you begin?
Well, I guess, one of the things that you need to look at, and a lot of people don't like considering this, but you need to have your money working for you somewhere where it can make more than just a really low rate of return. We know CDs aren't paying anything. We know really, really stable funds or bonds or something, they're just not paying enough to keep up with inflation. So you might have to, pull up on the pant leg and stick your toe back in the water, get back into stocks, get a little more volatility. I don't mean all of it, but get enough so that you can capture some of those higher gains to keep up with inflation so your money's doing more for you.
Now, Matt, I bet you get this question. I can't do anything because I'm on a fixed income.
Right. And the question there is, your fixed income may not keep up with inflation. When you have a certain amount coming in from your pension, that's what you're getting. When you have a fixed amount coming in from Social Security, that's what you're getting. Same thing even with an annuity. You may have a structured payout there. That's where you want to be looking and saying, okay, do I have any other avenues for growth, right? And on the front end, you may not want to put all of your assets into such a structured fixed approach because to Jay's point, you got to have some of that growth. We may need to have some funds in the market, have some funds in stocks, exposed to a little bit more of that volatility because at the same time, inflation's pushing things up. Well, guess what's happening? That stock price, that's the entry point. Well, if the price of your eggs is costing more, what do you think the stock price is doing at the same time?
So it sounds like it's really a juggling act here. So Jay, what's a great safeguard? Is it stocks? Is it equities? What's a good idea to fight the inflation monster?
I think everybody has to have an individual plan built for them, but I think generally big picture is you still need to have income, but you also need to have growth. It's now a blend. You got to figure out what that blend is for you. There was an old rule of thumb that the older I get, the safer my money needs to be. If I'm 50 years old, then 50 money should be out of the stock market. When I'm 60, I get 60% of my money out of the stock market. When I'm 80, I got 80%. That still kind of generally holds true, but when we got a lot of inflation, I'm not sure it holds as true as it did maybe back in the day. You may have to be willing to be a little bit more aggressive. I don't mean, aggressively aggressive, but just more than you are. Because right now, if you put the money in a CD, we're getting, 0 point nothing? Right? I mean, literally.
I was a little high, but around there, yeah.
I mean, I don't even know how they pay the postage stamp to send me my statement. It's like that costs more than the interest I got. You know what I mean? It's like, what's going on here? So you may have to look at other avenues, as you said, but growth and income. I think combining that, what's right for your risk tolerance is going to fit here. Yeah.
But Matt, is real estate a viable consideration or something to look at?
I think it absolutely is. You notice when inflation's happening, you're noticing real estate prices appreciating. Just think about the value of your home now versus 5 years ago. right? You see it readily. And at the same time, with real estate, you can go with more of rental properties, right? You could own a business that you're leasing out. You could have warehouses that you're renting out. There's different ways of addressing.
Well, there's real estate investment trusts.
Right.
There's stocks and ETFs that kind of focus on real estate. So you don't have
Absolutely.
to go out and buy a $400,000 piece of property.
Right. There are different avenues where you can get into that, right? And to your point, I think REITs are a great way of entering the real estate space without having to be a landlord, without having to deal with some of the headaches that could come along with real estate. Because to your point, there's some positives, but that is a large barrier, stepping into ownership of a building or something along those lines.
But well, even REITs, got to have a little caveat here. You can have publicly traded REITs. You can have non-publicly traded REITs. You could have some liquidity there. But again, when you're looking at that space, you're looking more for the income from it. So as long as you're getting the income, I would say that might work. But let me go back to this rental property. Well, you guys bought a property, 5-6 years ago?
We did. It was about 5 years ago.
And if I'm not mistaken, I got on Zillow and I looked up your property. You guys have a lot of equity. I mean, that thing's like almost 80% increase.
It has, and I was talking to my wife. I said, if we live in a van by the river, do you know how much money we could make off of this? And she said, I'm not doing it. She said, we got 2 dogs. I'm not doing it. And I was like, all right, well.
But consider real estate, I think.
Yeah, I think real estate can be a good option.
And there is some other good news, Jay, when it comes to Social Security.
Yeah, well, my mom, she gets about $1,000 a month, Social Security. Dad passed away a couple years ago, so she gets the one check. But recently, they're giving us a bump of 5.9-ish%.
They are, yeah.
So that $1,000, come January, she'll start getting $1,059, plus or minus whatever the actual math is. So it's another $59 a month for her. But you're telling me that's not all. She can't spend all that, right?
Right. Because yes, you get that raise, but guess what they tend to do at the same time?
They give,
they give, and then they take, because they raise your Medicare premiums. So all of a sudden, it goes. You go, hey, I got a 5% raise. Why did I only make an extra $1? Where's my other 49?
So there is good news.
There is good news.
But the package is not as big as it could have been.
It's not as rosy as the highlights tend to suggest, or those news headlines.
Well, all right. So Matt, you're going to wrap it up for us. What's the big thing here?
I think the key takeaway is inflation's here to stay. You need to have a way of addressing it. And really, you need to have a financial planner that's making adjustments to your plan as you go. Because when we're moving into that inflationary market, let's say you are invested in stocks and bonds. Well, as the markets move, as situations change, we need to make adjustments to that. And it needs to be an ongoing conversation. I think that's why a regular review with your advisor is so key. We want to meet at least once a year, because I sit down and one of my first questions is, how's everything going for you? And you go, well, 2 years ago, I was putting money in my savings account, and now I'm taking it out every month. We need to make adjustments. These things come up. Always.
Adjustments are never a bad thing, right? So we hope that's been helpful. How retirees can cope with inflation. Again, for Jay Tyner and Matt Landon, I'm Jeffrey Griffin with Semmax Financial Group. We hope you subscribe to the channel. If you have questions or would like to learn more, you can visit us online at semmax.com or 336-856-0080. We want to help keep you focused more on your life and less on your money. Thanks for joining us, and see you next time.